We have seen how the government regulates and supervises the banking sector. We want an efficient yet safe banking system. In this session, we are going to discuss the role of bank size. When a small bank fails, this is bad news for its community. However, when one of the largest institutions fails, this can threaten the entire financial system. These largest institutions are often called too big to fail. We are going to proceed in 3 steps. We will first examine the concentration of the US banking system. We will then introduce the concept of systemic risk. And then finally, we will see how, in recent years, government regulation has tried to address this immense challenge. The US banking system is concentrated. By this, we mean that a handful of banks control the bulk of borrowing and lending activity. While there may be thousands and thousands of banks out there, only a few mega banks are responsible for the bulk of this activity. JP Morgan, Bank of America, Citigroup, Wells Fargo, there are about 10 US mega banks. This chart is based on 2018 data from the FDIC. It shows the assets under management of 9 or 10 of these mega banks. The mega banks each have greater than $250 billion of assets. Collectively, they hold about 50% of all bank assets. There are thousands of community banks, each with fewer than $1 billion of assets, but they collectively hold around 15% of all bank assets. The US banking system has a handful of mega banks and a competitive fringe of small banks. Why do we see this industry structure? That's a hard question. There are 2 complementary views. The first says it is efficient for banks to grow large. Banks should scale up to exploit economies of scale. Banks should become more complex to exploit economies of scope. Scope economies can arise from selling multiple products that share fixed costs. An alternative, slightly darker viewpoint is that banks understand that the government will not allow the largest financial institutions to fail. If I am a mega bank and I am running into trouble, then the government will bail me out. The lender of last resort might give me a loan. The government might quickly arrange a merger for me. The government might even give me cash in exchange for my equity. These are all government subsidies or bailouts. This too big to fail policy encourages banks to get bigger in order to capture this subsidy. Bailouts are too big to fail policy in action. The unusual treatment of Continental Illinois Bank as it approached failure gave rise to the term too big to fail. In 2008, UK banks, including the Royal Bank of Scotland, were partially nationalised rather than forced into bankruptcy. A huge number of US banks were given cash in exchange for equity. This occurred most prominently through the Troubled Asset Relief Program, or TARP. Goldman Sachs and Morgan Stanley were even allowed to convert from investment banks to commercial bank holding companies in order to access this and other government backstops. Fannie Mae and Freddie Mac, the government-sponsored enterprises, also received a great deal of help from the government. During 2008, even some of the largest insurance companies received government assistance. When a financial institution fails, there may be spillovers to the financial system and the broader economy. Systemic risk captures this idea of potential spillovers. In the worst-case scenario, the flow of payments and credit through the financial system can come to a sudden stop and the economy shuts down. Which firms create the most systemic risk? Well, it seems natural that larger firms will have larger spillovers when they fail. It is also possible that smaller but more complex and interconnected financial firms will matter as well. Why is this? Well, larger and more interconnected financial firms are more likely to have linkages with businesses and other financial firms. This can be through their traditional borrowing and lending activities, but also through financial contracts such as derivatives. How should we think about systemic risk regulation? Well, systemic risk is a lot like pollution. An individual bank is not going to account for the downstream problems it creates when it fails. In the past, regulators have tried to minimize the risk of an individual bank failing. More recently, macroprudential approaches instead target these spillovers between financial firms. This resembles a tax on pollution. The Financial Stability Oversight Council, or FSOC, was established in 2010 to achieve this ambitious goal of managing systemic risk to prevent financial crises. The FSOC brings together a broad array of financial regulators twice a month. This includes leaders of the Treasury, the Federal Reserve, the SEC, the FDIC, and the Commodities Futures Trading Commission, which regulates derivatives markets. These regulators sit down, they have lunch, and they take a holistic view of the financial system. Rather than staying focused on supervising their individual markets, they collectively think long and hard about the safety of the financial system as a whole. They also have the power to designate any private firm as a systemically important financial institution, or SIFI. SIFI firms are subject to enhanced oversight. The SIFI banks are also called GSIBs, or Globally Systemically Important Banks. This classification is done by international bank regulators. These banks are the largest and most interconnected in the world. The GSIB banks are tiered into different systemic risk categories. JP Morgan is considered the most systemically important. HSBC might not be the biggest bank, but it is certainly the most global. In the second bucket, we have mega banks that are viewed as less of a systemic threat. ICBC, the Industrial and Commercial Bank of China, is by far the largest bank in the world in terms of assets, but it is mostly domestic in scope. And with the GSIB bucket 0, we have the complete list of globally systemically important banks. Okay, so the FSOC has now designated a set of institutions as systemically important. What next? How should supervision and regulation be designed to target systemic risk? The US government uses two approaches. First, SIFI firms are subject to stress testing by the Federal Reserve System. As discussed previously, stress testing encourages these firms to be forward-thinking about potential losses in a financial crisis. And then they should have sufficient capital to absorb these losses and survive. This exercise is even more important if one of these firms is systemically important. The second approach is to tax these institutions. Pollution taxes incentivize dirty firms to become clean. Systemic risk surcharges discourage financial firms from becoming too big to fail. Here are the systemic risk capital surcharges for the GSIB banks: Citigroup, HSBC, JP Morgan. These banks are considered the most systemically risky on the planet, and they are taxed as such. Compared with equivalent non-systemic banks, they must hold an additional 2 percentage points of equity per dollar invested. From a societal standpoint, we want these systemic banks to be even more resilient to potential losses. Let's wrap up. Systemic risk captures the potential spillovers from the failure of one bank to the rest of the system. Larger and more interconnected banks present the biggest systemic risks, and everyone believes that they are too big to fail. Too big to fail presents a major challenge for bank regulators. The basic idea of systemic risk regulation is to identify and then tax these large and complex financial firms. In the US, this is the responsibility of the FSOC. By subjecting the largest banks to enhanced oversight, the hope is that the system will become safer.